Most people think paying off a 30-year mortgage in 30 years is normal. The wealthy know better. They use a strategy called velocity banking to pay off the same mortgage in 5 to 7 years without earning more money or cutting their lifestyle. This isn't about making extra payments. This is about using the banking system against itself. The middle class parks money in checking accounts, earning nothing while paying interest on everything. The wealthy do the opposite. They turn their cash flow into a weapon that attacks debt from the inside. Velocity banking is one of their secret tools, and it works because of something banks don't want you to understand. The timing of when interest gets calculated matters more than the rate itself. Today, you'll learn exactly what velocity banking is, how it works step by step, and whether it's right for you. No sales pitch. Just the truth about a strategy that can save you tens of thousands in interest, or backfire completely if you do it wrong. Velocity banking is a cash flow management strategy that uses a line of credit to pay off higher interest debt or mortgages faster than traditional methods. The core idea is simple. You use a home equity line of credit, called a HELOC, or a personal line of credit as your primary checking account. Every dollar you earn goes directly into this line of credit, immediately reducing the balance and the interest you pay. Here's where it gets interesting. Most loans like mortgages use amortized interest. That means your early payments are almost entirely interest, with very little going to principal. A HELOC uses simple interest calculated daily on your average balance. This difference is everything. When you deposit your entire paycheck into the HELOC, you lower the average daily balance. Lower balance means less interest charged that month. You use credit cards for your monthly expenses, paying them off in full before interest kicks in. This creates a float where your money sits in the HELOC working to reduce interest while your expenses wait on the credit card. At the end of the month, you pull money from the HELOC to pay your credit card and make a large chunk payment against your mortgage principal. Then you repeat the cycle. Each cycle you chip away at the mortgage principal, eliminating years of front-loaded interest. The velocity comes from how fast your money moves through the system, constantly working to reduce debt instead of sitting idle. The average person sees a HELOC as emergency money or vacation funding. The wealthy see it as a cash flow optimization tool. They understand that amortized loans are designed to maximize bank profits through front-loaded interest. On a $300,000 mortgage at 5.5%, you'll pay over $300,000 in interest over 30 years. Your first payment might be $1,400 in interest and only $300 toward principal. Wealthy individuals refuse to play that game. They use velocity banking to make large principal payments early, eliminating the years of compound interest that banks count on. They also understand the concept called paycheck parking. Instead of letting paychecks sit in a checking account, earning zero interest, while debts accumulate interest, they park every dollar in the HELOC immediately. The middle class thinks about minimum payments. The wealthy think about average daily balances and interest calculation timing. They know a HELOC at 7.5% can actually cost less than a mortgage at 5.5% if managed correctly, because of how and when the interest gets calculated. Here's another key difference. The wealthy don't stop using velocity banking after debt is gone. They apply the same principles to build wealth. Once debt is eliminated, they redirect that cash flow into income-producing assets like rental properties or business investments, using the HELOC as a funding source that keeps their money working in multiple places at once. Let's break down actual numbers so you can see how this works. Imagine you have a $100,000 mortgage at 5% annual interest. You earn $4,000 monthly and spend $3,000 on all expenses, including your mortgage payment. That leaves $1,000 in positive cash flow each month. You open a HELOC with a $25,000 limit. You take $12,000 from the HELOC and make a lump payment on your mortgage. Your mortgage balance drops to $88,000. Your HELOC's balance is now $12,000. Next, you deposit your entire $4,000 paycheck into the HELOC. The balance drops to $8,000. Throughout the month, you use your credit card for the $3,000 in expenses. At month end, you draw $3,000 from the HELOC to pay off the credit card and make your mortgage payment. Your HELOC balance is now around $11,000 plus a small amount of interest. The following month, you repeat. Deposit paycheck, balance drops. Pay expenses, balance rises slightly. But each month, the HELOC balance decreases by roughly $1,000 minus interest. After 9 months, you can make another $12,000 chunk payment to your mortgage. Now your mortgage is $74,442 and your HELOC is $15,154. You've reduced total debt by over 10% in 9 months. If you had just made an extra $1,000 in payments on the mortgage, it would take 6 years and 5 months to pay off. With Velocity Banking, it takes 6 years and 4 months. That's only 1 month faster, but you save around $1,158 in interest. The real power shows up with larger cash flows and bigger HELOCs. Someone with $10,000 monthly income and $8,000 in expenses using a $75,000 HELOC can eliminate a $350,000 mortgage in 7 to 9 years, instead of 30, saving over $200,000 in interest. Paycheck parking is the engine that makes Velocity Banking work. Traditional banking teaches you to keep money in checking accounts. That money earns almost nothing while your debts charge interest every single day. Paycheck parking flips this completely. With Paycheck parking, you direct deposit your entire paycheck into your HELOC or line of credit. The moment that money hits the account, your balance drops and your daily interest calculation drops with it. If you have a $20,000 HELOC balance and deposit a $5,000 paycheck, your balance becomes $15,000 instantly. HELOCs calculate interest based on your average daily balance for the billing cycle. Every day your paycheck sits in the HELOC, it's reducing the interest you owe. If your HELOC charges 7% annually, that's about 0.019% daily. On a $20,000 balance, that's about $3.80 per day in interest. Drop the balance to $15,000, and it's $2.85 per day. The strategy gets more powerful when you time your bill payments. Apply your paycheck at the start of the billing cycle. Pay your bills and mortgage at the end of the cycle. This maximizes the number of days your money works to reduce the HELOC balance. The longer your money sits reducing the balance, the less interest you pay overall. This is the opposite of how most people operate. They get paid, money sits in, checking doing nothing, then they pay bills throughout the month. Velocity Banking with Paycheck parking makes every dollar work every single day to reduce debt costs. The biggest advantage is interest savings. By making large principal payments early on amortized loans, you eliminate years of compound interest. On a $300,000 mortgage, this can mean $100,000 or more in savings over the life of the loan. Speed is another major pro. You can pay off a 30-year mortgage in 5 to 10 years depending on your cash flow, without earning more money or drastically cutting expenses. You're simply using the money you already have more efficiently. Velocity Banking teaches you cash flow management skills. You become hyper-aware of every dollar coming in and going out. This financial discipline creates habits that serve you long after the debt is gone. You learn to optimize timing, interest calculations, and cash flow in ways most people never consider. The strategy also improves your credit utilization and credit score over time as you pay down debt balances. You're not creating new debt, you're reorganizing existing debt to work in your favor. Once you eliminate consumer debt and mortgages, you can redirect that massive cash flow into wealth-building assets. Another pro is flexibility. Unlike refinancing, you're not locked into new loan terms or paying closing costs. You can adjust the strategy month to month based on your situation. If you have extra income one month, you can accelerate faster. If expenses rise, you can slow down temporarily. Velocity Banking can backfire badly if you lack discipline. The strategy requires meticulous budgeting and tracking. If you're not organized, or you overspend, you'll end up with more debt than you started with. You're essentially giving yourself access to more credit, and that's dangerous if you can't control spending. Variable interest rates are a major risk. HELOCs typically have variable rates tied to the prime rate. If rates jump from 7% to 10%, your strategy can fall apart. Your minimum payments increase and the interest savings disappear. You need a plan for rate increases, or you could get trapped. The strategy requires positive cash flow. If you're living paycheck to paycheck with no surplus income, Velocity Banking won't work. You need that gap between income and expenses to make progress. Lose your job or face a major expense, and you could be in serious trouble with a HELOC balance and no way to pay it down. Complexity is another con. You're managing multiple accounts, timing payments, tracking daily balances, and monitoring interest calculations. This isn't set it and forget it. It demands attention and understanding. Many people give up because it feels overwhelming or they make mistakes that cost them money. There's also emotional stress. Running your financial life through a line of credit can create anxiety. You're technically in more debt initially, as you use the HELOC to pay down other debts. Some people can't handle seeing that HELOC balance, even though the total debt is decreasing. The strategy has limited long-term benefits once debt is gone. Unlike building assets, velocity banking is primarily about debt elimination. Once you're debt-free, you need a new strategy for wealth building. It's a tool for one specific job, not a complete financial system. Velocity banking works best for specific people in specific situations. You need home equity or good credit to qualify for a HELOC or personal line of credit. Without that, the strategy is off the table. You also need stable, consistent income. Variable income makes the strategy much riskier and harder to execute. You must have positive cash flow. If your expenses equal or exceed your income, there's nothing to work with. Velocity banking accelerates existing positive cash flow. It doesn't create it. You also need strong financial discipline. If you struggle with budgeting, overspend regularly, or have trouble sticking to plans, this strategy will hurt you more than help you. The strategy makes sense if you have significant debt you want to eliminate faster, particularly mortgages or high-interest consumer debt. It makes less sense if you're already debt-free, or if your debts are small enough to pay off quickly with normal methods. You should avoid velocity banking if you're risk-averse about variable interest rates, or if managing multiple accounts and payment timing feels too complex. There's no shame in choosing simpler debt payoff methods like debt snowball or avalanche if those fit your personality better. Ask yourself these questions. Do I have at least $500 in positive cash flow each month? Can I track expenses and stick to a budget? Am I comfortable using debt strategically? Do I have emergency savings separate from this strategy? Can I handle the stress of seeing a HELOC balance? If you answered no to any of these, velocity banking probably isn't your best option right now. Velocity banking is a legitimate strategy that uses cash flow timing and interest calculation differences to eliminate debt faster. It's not magic, and it's not for everyone. The wealthy use it because they understand how banks make money, and they're willing to use complexity to their advantage. The strategy works when you have stable income, positive cash flow, strong discipline, and the ability to manage multiple moving parts. It fails when people lack organization, overspend, or get caught by rising interest rates without a backup plan. If you decide velocity banking fits your situation, start small. Test it with a portion of your available credit before going all in. Track everything. Know your numbers. Have an emergency fund completely separate from your HELOC. And most importantly, have a plan for what you'll do with your cash flow once the debt is gone. The goal isn't just to be debt-free. The goal is to build wealth. Velocity banking can get you to debt-free faster, but then you need to redirect that cash flow into assets that produce income and grow over time. That's how you actually build the wealth that gives you options and freedom. If you want more strategies like this, that the wealthy use, but most people never hear about, subscribe to Stealth Wealth Hacks. Hit the notification bell so you don't miss the next video. The financial system is designed to keep you playing by rules that benefit banks, not you. Every strategy you learn is one more tool to take back control.